Welcome to the Brain Picker Pro Show, live from Lake Wiley, South Carolina. I'm Larry Goins. Thank you guys so much for watching, man. I really appreciate it. And thanks a lot for sharing the video. Thanks a lot for commenting, leaving us feedback. We really appreciate that because it takes a lot to put this together, arranging everything. You got to have an editor, post editor, somebody to post all this stuff. So thank you guys very much. We do want to keep it free. We want to keep it flowing and have really good guests. And today's no exception. I'm really excited today because today I've got on a guest, Darrin Gross. Darrin is a real estate investor, and he's also an insurance guy. He knows insurance inside and out, any different kind of insurance, working with investors. That's all he does is works with investors. So it's going to be a great show today. So please give a warm welcome to Darrin Gross. What's going on, buddy? How you been?
I'm good, Larry. How are you?
Man, I am doing awesome. Hey, why don't you start out and tell our viewers and listeners a little bit about yourself?
Sure. So I'm based in Portland, Oregon, and I am in.
Against you.
Yeah. Okay. Well, thanks. Yeah. No, it's out on the West Coast. We're the little sister of the big or the West Coast. You got Seattle, San Francisco, and LA, and we're one of the smaller ones. But anyway, I've been out here for almost 30 years. I grew up back in the Midwest, came out here to work for an insurance company. I've been doing insurance ever since. And along the way, ran into some property investors. I was a hungry insurance agent, and they needed insurance, and they kept calling me for more insurance. So they kept buying more houses. And
Wow.
Over time, I kind of was asking them, what they were doing, how it was working, and they kept sharing a little bit more. And at the time, I just wanted a new car. I wanted I wanted enough money for a new car payment. And they were telling me about how they were making $100 a door kind of thing, $100 there, $100 there, $100 there. And I was going like, God, a couple of these and you could have a new car. And anyway, with that, turned to one of my clients and told him how I needed to get into it. And he said, "You want in? I'll sell you this one." And I was like, "This one? That's pretty rough." And anyway, he had mentioned a price, and I knew that he needed $10,000 is what he really needed. He didn't need the price that he offered. And so I borrowed $10,000 off a line of credit I had, gave him that, and he carried the contract. And 7 months later, it sold. It was an accidental flip. I had another client that wanted to get into real estate, and I was hooked. Been in real estate ever since. And I'd say, over the time, I've got clients that do all sorts of different things, but majority of my daily efforts are spent talking with and looking for real estate investors that I can talk with or work with on their insurance. And my wife and I, we've got a handful of single family properties. We've got 6 out here. And then a little over a year ago, we bought a 12 unit apartment building. So we're looking at trying to, transition that way.
That's great. So you got a handful of single family rentals. You've got a 12 unit that you bought about a year ago. Is the 12 unit close by?
No, it's close to you. It's clear across the country. Yeah, my mother-in-law, she lives down in Florida, and my wife's kind of identified that as the long-term destination. And so I thought, if that's the long-term destination, maybe I should start looking down there. And so we found this, and it's been a learning lesson. But I think the fundamentals that I've learned there, it wasn't such a big property that was going to kill me if something blew up.
Sure.
It's a good, it was a good opportunity to get in and learn. And we've learned a lot, and we've improved the property a lot, and the rents are up. And in fact, I just got an email last night from my property manager. We got another unit that we turned. We're getting rents nearly double of what we paid, or when we bought the property, what the rents were before we bought it. So Good. It's good, and like to keep increasing the rents, because that's how you increase the value on the commercial properties. So
That's awesome, man. I love that. I love it. And you mentioned about you talked to the property manager. I was just getting ready to ask you, you don't have your mother-in-law managing that for you, do you?
no, 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 that would not be good. That would not be good. Yeah, probably wouldn't have a mother-in-law anymore. So
Or a wife, probably.
yeah. A little friction there.
That's funny. That's funny. So tell us a little bit about, insurance is very, very important. There's insurance has to do with risk, right? And there's basically three different ways you can handle risk. Why don't you jump into that a little bit?
Sure. So from a risk management philosophy, we consider there's three basic strategies. You can avoid the risk, which, like, if you're looking at a property to buy, you can just say there's too many problems there, we're not going to do the deal.
Right.
You can minimize the risk, which may be a price negotiation, or bring a partner, or somebody there to lessen your risk. Or you can transfer the risk. And insurance is basically, that's what insurance is a vehicle to transfer the risk, so that if something blows up, that there's some way to make you whole. And so that's those are the three basic strategies of risk management.
Avoid, minimize, or transfer, right?
Yep.
That's good. What are some ways you can minimize the risk?
Well, I think that insurance companies are always looking to minimize the risk. So that's like when you go to buy a property, that's why they ask you all those questions, right?
And it's really to educate you, the client, to help minimize that risk, which helps you and the insurance company, correct?
Right. Because let's just say you've got two properties, and one has got roof problems, and it's got cracks in the sidewalk, and it's got old electrical panel. Maybe it's fuses, maybe it's Zinsco or Federal Pacific, or you've got old galvanized pipes that are maybe past their life expectancy. You can go on, but if you look at that as opposed to a brand new property that's got all new systems with life, plenty of years of life, which one do you think is going to give you more trouble, or potentially more trouble? And I think that anybody that's been working in real estate, or thinks through it a little bit, would recognize that the property with the older systems is going to create a potentially more risk, more potential repairs needed, more cost to fix or repair, or just potential if it's insured, a claim. That's why the insurance companies are always looking and saying, hey, wait a minute, how old is the roof? All right. How old is the electrical system? What kind of electrical system? What kind of electrical panel? Tell us about the plumbing. What type of pipes does it have? The heating system, how old is the furnace? What kind of furnace has it been maintained? And then you go out and you look on the grounds, for trip and fall kind of stuff. And, if your sidewalks have cracks and uneven surfaces that are potential trip and fall hazards, that's basically the insurance company. The underwriter's job is to avoid signing the insurance company up for a claim, right? And so when you are a buyer, if you know these things that the insurance company is looking for, it can position you in a better way to maybe negotiate with the seller that these repairs that are going to need to be made, or at least budget properly for what it's going to cost you to insure your property. Because I think one of the things I see a lot is when people are making an offer, they'll look at what's the seller been paying for insurance. And if the insurance has only cost the seller $300 a year, then they're confident that that's what it's going to cost them, right? Well, when they go call their agent and they tell them about the property and they run it through their model, they find out, no, it's going to cost them $600 or $800 a year.
Wow.
Or whatever that is. Why is that? Well,
Right.
and so when you try and, we talked about minimize your risk. If these things are identified by your new company but haven't been identified by your old company, those are things that you need to address so you can, keep your coverage affordable.
That's
So,
really, really good. That's really good. So what you're saying is, by understanding a little bit more about what an insurance underwriter looks for, you can actually look at those things yourself and even talk to the seller and use it as a negotiating tool. Hey, look, I'm going to have to fix this sidewalk here because this is a trip hazard, and my insurance company is going to make me fix it, so it's got to be added to the repair cost. Correct? Is that
exactly.
what I'm
Yeah,
hearing?
exactly. And I think that it's probably not something that gets recognized as much on a single family home as it does on the commercial, on more multifamily properties and stuff. But
Right.
it's inherent. I just was looking at one myself here the other day, and down in the Carolinas and kind of Gulf Coast states, you guys have those windy events they call hurricanes, and they can cause a lot of damage.
Right.
And if you own the property outright and you don't have a bank on the property, you can forego that wind coverage if you choose to, right?
Right.
But if you're buying and you're going to have a bank involved, the bank's not going to let you do that.
Sure.
So if the seller's insurance number shows that he's paying $3,000 a year, and you use that for your underwriting, you're going to be really in for a surprise when you find out when you go to buy your policy that it's going to cost you substantially more. And so things like that. I guess that's the when you say minimize, how can you minimize your risk with insurance? I would say definitely do your due diligence and talk to your broker sooner in the deal rather than later, so that you can address whatever concerns they may have, get the answers. Because a lot of times what I find is that the selling broker, they're really not interested in probing too deep to find out what lies beneath. Their job, if you think about the listing broker, their job is to get the property listed, right? And if they can't get a listing, they can't make a sale. So they want to get it listed.
Right.
And once they get it listed, then it's up to you, the buyer, to find out what might be lurking or potentially a problem. So due diligence, get your insurance broker involved early.
That's good. Get your insurance broker involved early. That's really, really good advice. I like that. So let's talk about, as an investor, I don't care if you're a brand new investor or an experienced investor, what are the different types of insurance that an investor needs to be aware of that are available? Because most people just think insurance, okay, homeowners insurance or a fire policy or a landlord policy, but there's all builder's risk. There's all different kinds. Can you kind of go through the different kinds of insurance and when it's used?
Yeah, absolutely. And I appreciate you recognizing there is a difference. And I think that the first thing I would ask is that I would point out is that you have to know, what is your strategy. If you're going to be a buy, hold operator, that's a different strategy than somebody that's flipping a property, right? Or somebody who's buying a property that needs renovation. If you're buying a property and you're going to operate it, it usually implies that the building is functional and that the repairs needed are minimal. Okay, and that's going to be probably your least costly insurance, and it's going to be your most normal sense of what one would expect to have with insurance. You mentioned builder's risk. A lot of times, you and I were talking earlier about homes that maybe are vacant or that need some renovations, or a builder special, or however you want to phrase that. But
Right.
the underwriter, again, the underwriter's job is to determine what is the condition of the property, and from there determine what they're comfortable, willing, or comfortable to offer coverage for. And if you have a property that's vacant that needs a lot of work, the first thing is you're probably going to have to get a builder's risk policy. And a builder's risk policy is designed to cover the work that's being done to the property. And I'm just talking about the physical property. So if you have, your walls, your roof, your floors, and you're going in there and you're redoing kitchens and baths and new roof, new windows, doors, whatever that might be, that's not a ready to be occupied. There's a lot of work going on there. So builder's risk policy is designed to cover the structure as it is when you buy it, plus all of the improvements you make to it. And so the value is typically, most companies will end up with a replacement cost number. So what it would cost to build the property back. But if something happens in the process, you won't get that full amount. You'll get what it was when you started, plus whatever you've put into it. So if you're halfway through your improvements, you would get what you started with plus whatever your improvements are, as opposed to a full replacement cost value. The other thing that I want to point out there is that a lot of times when people are investing, that's as far as they think the insurance through, is at the builder's risk. And the reason why they think that is because there's a bank or a lender or somebody that requires that they have insurance, right? So in that instance, you have to understand that coverage, while it's in your name, it's to benefit the lender, right? Because the lenders put their money into your property. They've got a lien against that property. If anything happens to that property, they want to make sure that they're protected, right?
Right.
So we've got the property covered, the structure covered. The thing that I think a lot of people fail to recognize is the liability portion of the equation. And liability is things that happen to other people that you're responsible for. Okay, other people's their person or their property. So if you have somebody that comes on your property and they trip or fall or they get hurt, that builder's risk policy isn't going to respond to their injuries. Okay, so you need to have some sort of at a minimum, some sort of a trip and fall policy. And I recommend that. It depends on what you're doing. If you're doing one property, there's different companies out there that may just be able to give you both trip and fall plus the builder's risk. But if you're doing, I've got one client that does 50 plus a month. Okay, you want to make sure you have something where you can extend liability to each one of these properties, and so that if anything were to happen, you don't want to lose everything you're building because of somebody got hurt on a property and they sue you for everything you've got, right? And then the third piece to this that I'll bring up that I think gets missed a lot of times is the completed operations, right? We talked about trip and fall, which is if something happens at the property. But once you sell the property, if you've done any of the work, whether you put the windows, doors, roof, put the new plumbing in, electrical system, whatever it is, if any of that goes haywire and ends up causing injuries to the property or to the person, and right, you are the seller, they're going to come back to you. Okay, and if you don't have insurance, and or you haven't properly transferred the risk to your subcontractors, okay, that's the other thing is if you're hiring subcontractors, you want to have a contract between you and your contractors that ties you to them and requires that they insure you on their policy for any of the work they're doing. I've seen it happen, and it's not always that it happens. It's not every day it doesn't happen, but when it happens, it can really go wrong. And for somebody first starting out and they're not aware, they may not understand all the exposure they have. But I can tell you that if you learn the hard way, you'll never forget. And we always recommend lay it out just like we did. Builder's risk is the lowest level, premise liability is the next level, and then the third, if you're doing the work, make sure you're protecting yourself from any future liability. Does that make sense?
Absolutely, it does. Absolutely, it's really good. Like you said, it's just a transference of risk, right?
Right.
So it's really good. So builder's risk is like if somebody's buying a property and they're going to fix it up and sell it, or fix it up and rent it out. That covers the period while it's vacant. Contractors are coming in and out and stuff like that, right? So,
right, but it's just the structure. If something happens to the structure, it's not about anybody getting hurt. It's just whatever happens to that structure. Yeah.
Right. If somebody breaks in and vandalizes, steals out the copper, steals the building material that's inside waiting to be installed, all that good stuff. But they still need the trip and fall.
Correct.
Yeah, I've never heard that term, trip and fall.
Well, premise liability, it's
liability. It's just liability. That's the term I know, is just
Yeah,
liability.
yeah, yeah, yeah. Well, and liability gets divided into two. There's two sections of liability. Of one is the premise, which is the address, where the property is located. If anything
Right.
happens on that property while you own it,
Uh-huh.
and then the completed operations is that once you've sold it and you're gone and you're on to the next one. If you're having dinner with your family on Thanksgiving and the phone rings and it's somebody that you sold a house to that's all irate because there's water pouring in through the light fixtures or that kind of thing. That's a completed operations, and
Right.
yeah. So
Like if you used some PEX plumbing that has a class action suit against them, or if you use some Chinese drywall or something.
yeah. No, those are known issues, and it all goes back to, again, your how can you protect yourself down the road? I mean, because it'd be a shame to go and make all this money and feel like you're doing really well, only to find out that you've got an exposure there that you could have solved for a little bit of money, and had somebody to defend you and settle the, or to fix the or pay for the fixes. Uh, but it happens. And I don't think it happens as much as it. I haven't seen as much lately, and I think maybe it's people are learning that. But I still see occasionally the person that went to the seminar and they're all ready to borrow some hard money, and they've got a property they need to get some insurance on, and they just want the builder's risk, insurance. And we started asking them about the liability. They're like, no. I've got my contractor. He has insurance,
Right.
And I'm saying the contractor has insurance, but have you got a contract with the contractor that requires him to name you as an additional insured? And you can do that. And the only thing I'll say to that is that if your contractor is out doing work all over town, and it just so happens he's doing it wrong all over town, and there's claims that come in ahead of your claims, and all of a sudden there's a line of claims that put reserves on his limits that exceed what his policy limits are, you could still be without. So again, it's a matter of making certain you are taking care of you, and not always relying on everybody else, or that nothing will go wrong.
Exactly. That's really, really good. Can you tell us a little bit about, I mean, I've had builder's risk in the past because I used to do rehabs. I don't do rehabs anymore, but I used to do rehabs, and we had what's called a monthly self-audit builder's risk. Can you explain
Sure.
a little bit about, maybe not necessarily just that, but kind of how a builder's risk works? Because you got properties every month coming on the policy and going off the policy.
Sure. Now, and just to be clear, I'm assuming you were doing some volume at the time when if you had that kind of policy, because
Right.
if you're doing, I'd say north of 10 or 12 a month, then that's probably the way to go, because it truly, it looks at just what is your exposure for that month. So if you bring 3 on and you sell 4, then, or whatever that is,
Right.
you've got a running total, as opposed to just buying one policy for a year on a property and you're only going to have it for a few weeks or a few months or whatever kind of thing. So if you're doing a lot of properties, that's a great way to go. If you're just getting started and you're starting with one and you're going to fix it, and you're I mean, this is the classic case I've seen, is somebody calls me up like, we're going to be in and out of this thing, and 6 months tops, and they only want to buy the 6-month policy. I always caution against that on the first one, and
Right.
until you get your systems in place, I would recommend that you buy the annual policy, because what happens is that if you don't get the property sold in 6 months, then you have to buy an extension. And by the time you buy the extension, you could have paid more than you would have paid one time for the year. And then if you go through that first extension and now you say, oh, we're still not done, it's kind of slow, whatever, then we have to go back to the underwriter and say we need a second extension. Sometimes they're willing to do that. Sometimes they're going like, well, what's going on? Why do we need a second extension? Do these guys know what they're doing? So the if you're just starting out, I would encourage you to get the annual policy, get your systems worked out, know how to get in and out of a property, know who your contractors are, know what you're doing. And then as your volume increases, I would encourage you to look at something more like you were talking about, like a monthly reporting form.
That's good. Okay, so those are really good things that a contractor is going to need, or I should say a rehabber is going to need, a guy who's doing fix and flips. What kind of insurance does a landlord need?
Sure. So again, depending on what you have, I typically work with people that have more than a dozen single families. If I'm working with people that do single families,
Right.
I like to provide a master policy because it gives you the flexibility. If you buy a property today, you can call me. We can add it to the policy. We can get higher liability limits. But what you need though is just for coverage. You want to make sure you get the structure covered. You want to make sure you protect your loss of rents. And I was telling you the property my wife and I bought down in Florida. When I was going through the purchase, I recognized I don't do a lot of business down there, so it wasn't. I know I can insure properties down there, but I asked the broker. I said, "Do you have anybody you use or you recommend for insurance?" And they made a recommendation. And I contacted them, and what I found out was that they, one, I don't know how good they were because they didn't offer to protect my loss of rents. And I was going like, holy moly, first off, I'm certain the bank's going to want that, but this is my this is if something happens, if the roof blows off and we can't operate or can't rent the property out, there's going to be a loss of income there. And so definitely you want to make sure that you get your rents protected.
Right.
Liability is again, like we talked about before, it gives you basically the trip and fall. And if anybody gets hurt on your property, there's coverage for you there. The one thing I do like to point out to people is that when you're insuring the building, you want to make certain you're getting a real replacement cost value. I've seen it happen too many times where people buy it for a number that's low and they go, oh, no, I only bought it for that. I only want to insure it for that. Well, the policy has a penalty clause in it if you underinsure it. And if you have a loss, you may not get what you expected if you underinsure your property. So I always encourage people to make sure you've insured to the replacement cost value to avoid that penalty as well. But so as far as an operator, you want to get your building, your rents, make sure you got your building insured for the value, your liability. If you have multiple properties, master policy I recommend, because then you only have to deal with insurance once a year. You're not getting, every day you go to the mailbox, another envelope with just a policy number and a premium due, and you don't know what it's for. So that I'd say master policy, something as you grow your portfolio.
That's great. That's great. So are there any other kind of policies that a landlord would need?
Sure. And it depends on how involved you are. If you are managing the property yourself, or if you have a property manager engaged in between you. But there's, if you have employees, you're going to need workers' comp. Recommend you look at employment practice liability, covers kind of any hiring, firing kind of thing. There is property management professional liability, which covers any kind of discrimination. If you make an error in screening clients and somehow you get a lawsuit against you there.
And that's what it's called. What again?
Property management professional liability, or property management errors and omissions.
Oh, E&O. Okay,
yep.
Good. That's what I know it as.
Yep. And a couple other things I always like to point out. Be sure you understand that the standard policy excludes flood. It's also going to exclude earth movement if you live in an area or you have a property in an area where there's earthquakes. And always I encourage people to look at an umbrella. If you have just one property, it might not necessarily be as important, but as you grow your portfolio, an umbrella is a very inexpensive way to get higher limits should something go wrong and protect your assets.
That's good. That's good. So, Darren, what kind of insurance would a wholesaler need? A guy who's just doing fix and flips, he may or may not own the property. Sometimes you have to do a double closing where you buy it at 10 o'clock and sell it at 10:30. Sometimes you just do assignments. It's more of a business than an investment. What kind
Sure.
of coverage would a wholesaler need?
Well, it's funny you bring that up because I've seen guys go with almost nothing. I wouldn't recommend that. I would encourage you to get at least and again, it depends on how you're set up. If you're set up as a business or if you're just set up as an individual, I would encourage you to get a policy, period, just a business owner policy that recognizes you have some sort of operations, that you've got some property and some sort of liability. But if you're not taking possession of the property, so it's never really going into your portfolio, you're not ever going to operate the property. At the minimum, you'd want to make certain you have some sort of just a standard package, or what we call a business owner policy, to give you some basic general liability, in some property. If you're, I would say that's just at the barest minimal amount. And again, I'd say if you have any employees, if you've got people calling, making calls or doing anything like that, you should make sure you have workers' comp as well.
Good. That's good. So basically, basic liability insurance, plus if you have any employees, you need some sort of a workers' comp.
Yep.
That's good. That is good. So Darren, if somebody wanted to reach out to you, if they had questions about insurance, about their portfolio, about their business, about, getting set up with you, how would they reach out to you?
Sure. So my direct line, I'm going to give you just my cell phone. It's probably the best way. It's 503-504-7619. That's my cell phone. Or you can reach out to me. Email is Darrin, it's DARRIN, at jdarrengross.com. That's my website. That's letter J, Darrin, DARRIN, Gross, GROSS.com.
Awesome. Man, I really, really do appreciate you being on here today. I appreciate you taking the time. It's really, a lot of people don't think about insurance as being, educational and informative. It's just something I got to have, right?
Right.
But really, you've made it informational, educational, and I think you've shared a lot of good information today, and I really appreciate it.
Sure. No, I appreciate that, Larry. And one more thing, if I could, just want to invite your listeners to check out. I do have a podcast. In fact, you were a guest on it, and
cool.
Encourage everybody to check it out. It's Commercial Real Estate Pro Network, also known as CREPN Radio, and we have weekly guests, either investors or professionals, and get into different aspects of real estate investing.
Great. That sounds good, man. Guys, check it out. So thank you so much for being on. I really, really appreciate it. And guys, please share this. Please like it. Please, please give us some feedback. We really appreciate that. And keep watching. We got a lot of archives at brainpickapro.com. We also have the Bragg Show every Wednesday at 2. So bragradio.com for that. So thanks, everybody, for watching. I really appreciate it. Thanks, Darren.
Thanks, Larry.